Hello, FIT students. Welcome to International Economics, Theory and Policy. Today I will talk about part 1 of chapter 13. I will be talking about national income accounting and the balance of payments of the United States. I will specifically discuss different components of national income and the balance of payments. I will also describe the balance of payments accounts and explain its relationship to the current account balance. We will also discuss how changes to current account affects United States net foreign wealth. Now let's focus on the national income accounts. Basically, national income accounts measures three major variables in the economy: national income, value of production, and value of expenditure. This also involves saving, investment, and the current account. In more technical terms, however, national income results from production and expenditure within a given nation. National income is the income earned by a nation's factors of production. Producers earn income from consumers, like us. Ideally, production and consumption should equal to each other in a market economy. Just like demand and supply is equal in a market equilibrium, production and consumption should equal to each other in a free market economy as long as the market is in equilibrium. How is national income measured? The first most important indicator of national income is GNP. GNP refers to gross national product. GNP is the value of all final goods and services produced by a nation's factors of production in a given time period. Factors that are used to produce the goods and services. So these are the workers who provide the labor services, physical capital like buildings and equipment, natural resources, and others. So basically, when you answer the question of what are the factors of production? What are the factors of production? Factors are used to produce goods and services. Workers provide labor services. Physical capital provides buildings and equipment, and natural resources and others. In other words, in simple terms, land, labor, and capital are factors of production. When we talk about factors of production, we're talking about three major variables: land, labor, and capital. The national income accounts has four major components: consumption, investment, government purchases, and the current account balance. So it's very important to know these four major components of the national income accounts. And these are the four major components of GNP, in other words. Okay? So GNP has these four major components. Let's start with consumption. Consumption is an expenditure by domestic consumers. When we, as domestic consumers, buy goods and services in the economy, we are consuming those goods and services. When we go to a supermarket, when we go to a restaurant, or when we go to a college, we are basically engaging in the activity of consumption. Now let's look at the investment. Investment is an expenditure by firms, meaning the corporate enterprises, on buildings and equipment. Let's say when a company like Apple buys a piece of land to build a factory to produce microchips in China, that is considered an investment. Again, when a company like Apple buys a piece of land to build a factory in order to produce microchips, let's say in a country like China, this is considered an investment by Apple. But then what is a government purchase? Government purchase is an expenditure by the national government on goods and services. Let's say this is an expenditure by the US government on goods and services. For instance, if the US government engages in the production of ventilators, or if the US government engages in the production of face masks during the coronavirus, that is considered an expenditure by the government on goods and services, which is also referred to as government purchase. Then what is a current account balance? Current account balance is always a difference between exports and imports. Exports minus imports refers to net expenditures by foreigners on domestic goods and services. And CA, including the current account balance, is always found by the difference between the export and the imports. But you have to find it by applying the strict formula. Exports minus imports, which refers to net expenditure by foreigners. The reason why the US current account balance is always negative because our imports are always larger than our exports. So look at figure 13.1, which shows the US GDP and its components: consumption, investment, government purchases, and the current account balance. You see the current account balance is most of the time negative, minus number, because our imports are larger than our exports. This is also mainly because we find the current account according to the formula of exports minus imports. To have a better understanding of national income, gross national product, meaning GNP, must be adjusted to the following factors. The first one is depreciation. What is a depreciation? The depreciation is a term that we use to describe the reduction of the value of an asset. So we apply the term depreciation of machines. Depreciation as a term is always applied to equipment, buildings, and machines. This refers to a reduction in the value of an asset with the passage of time, due in particular to wear and tear. Depreciation of machine, in other words, this amount of depreciation, is always subtracted from GNP. You cannot involve this in GNP. You have to subtract it from GNP because of the fact that the physical capital always depreciates with the passage of time. The second important factor that we need to adjust GNP for is the unilateral transfers. However, unilateral transfers are included in the GMP. For instance, depreciation of machines is subtracted from GMP. However, unilateral transfers are included in GMP. So what do unilateral transfers include? They include foreign aid, gift to foreign governments, retirees who left the country but lives in Mexico or Jamaica with their pension payments or social security. Unilateral transfers also involve someone who is working in another country. Let's say payments of expatriate workers sent to their home countries is included in unilateral transfers. Who are these expatriate workers? For example, these are American people or Americans working in London would be considered an expatriate workers. And their payments sent to their home countries is always included in the GMP. Okay? Another approximate measure of gross national income is gross domestic product, which is GDP. GDP includes GMP minus payments from foreign countries for factors of production plus payments to foreign countries for factors of production. So what is a GDP? GDP measures the final value of all goods and services that are produced within a country in a given period of time. So when you find a GDP, you need to use the formula of GMP minus payments from foreign countries for factors of production plus payments to foreign countries for factors of production. But what are these payments for factors of production? We also call them as factor payments. Factor payments are the income countries receive for supplying the factors of production, like land, labor, capital, or entrepreneurship. Okay? Factor payments or payments for factors of production are the income countries receive for supplying factors of production, such as land, labor, capital, or entrepreneurship. For instance, wages is a factor payment because wages are being paid for services of labor. Interest is a factor payment because interest is paid for the services of capital. Rent is a factor payment. Rent is paid for the services provided by the land or other immovable assets. And profit is a factor payment. Profit is for the factor of payment to the entrepreneurship. So in order to find the gross national product, which is GDP, we must deduct the factor payments from foreign government, but add the payment we make to foreign countries. As I said, we must deduct the factor payments from foreign government, but add the payment we make to foreign countries. Here is the national income in an open economy. So let's go over the components of national income accounting for an open economy. Following the formula of Y equals C plus I plus G plus CA, which is the current account. Okay? Current account is the net expenditure by foreign individuals and institutions. And how do we find the current account of the United States? we always take the difference between the exports and the imports. Exports minus imports give us the current account, which is denoted by CA. So let's go over this formula again. So Y here stands national income for an open economy. C is consumption, I is investment, G government expenditures. You need to add to that the CA, the current account, which we find according to export minus imports. Export minus imports is the net expenditure by foreign individuals and institutions. And don't forget, most of the time, United States has a negative current account because our exports are smaller than our imports, right? Or our imports are larger than our exports. That's why we always get the negative number. If we want to have a positive trade balance in the US economy, if we want to have a positive trade balance in the US economy, we need to increase our exports and decrease our imports. If exports are larger than imports, then we will have a positive trade balance or the positive current account. Another term we use to describe the current account is the trade balance. We either have a positive trade balance or a negative trade balance. The reason why we have a negative trade balance is because our imports are larger than our exports. In other words, we consume more than we produce, or we consume more than we save as an economy. Now let's go over the assumptions of the national income accounting for an open economy. The number one assumption is that when production is higher than domestic expenditure and exports higher than imports, current account is larger than zero and trade balance is larger than zero, meaning that both the current account and the trade balance are positive. So when a country exports more than it imports, it earns more income from exports than it spends on imports. Therefore, we say that the net foreign wealth of the United States is increasing, or it has a positive trade balance. And the second assumption is that when production is less than domestic expenditure and exports are less than imports, current account is always smaller than zero, meaning negative, and trade balance is also smaller than zero, meaning negative. When a country exports less than it imports, it earns less income from exports than it spends on imports. Therefore, we say that the net foreign wealth of the United States is decreasing, or the current account and the trade balance are negative. If those two are negative, then we say that the net foreign wealth, our net foreign wealth, is decreasing. If we have a positive balance, on the other hand, we say that our net foreign wealth is increasing. Of course, ideally, we want to have a positive trade balance and an increasing net foreign wealth. We see here how GNP is calculated, right? Gross national product. We take the sum of C, I, and G, meaning government purchases. And then we deduct the imports from exports, or exports minus imports. Then we take the sum of all variables. right? Consumption plus investment plus government purchase plus export minus imports. Export minus imports referring to the current account balance of the United States, CA. Now let's look at the savings component of the current account balance. Okay, savings component. So we defined savings according to national income that is not spent on consumption or government purchases. So in other words, if we do not spend any money on consuming for goods and services, or if the government does not purchase anything or does not spend money on buying any goods or services, then technically speaking, our economy is engaging in the process of saving. So national saving is the income that is not spent on consumption or government purchases. In other words, to find national saving, we deduct consumption and government from national income, right? So S equals to Y minus C minus G. In other words, we deduct consumption and government from the national income, which is Y, or which is GNP, right? An open economy builds up its capital stock, which is I, or acquires foreign wealth, which is CA. So there are two ways of saving, right? We either build up our capital stock, right? Or we try to acquire foreign wealth. And how do we try to acquire foreign wealth? Only if we keep exports larger than imports. Then how can we as an economy build up our capital stock? Only if we make investments. So if you combine the investment with the current account, with a positive current account, we end up saving for the economy. So another way to describe national saving is to add up, or the sum of investment and the current account balance. There are also two other components of national savings, two important components of national savings. One is a private saving, and the other one is a government saving. Private saving is the part of disposable income that is saved rather than consumed. Okay? The private saving is done by either individuals, meaning the consumers, or the corporations, right? So it's part of the disposable income that is saved rather than consumed. In other words, national income minus taxes, right, minus consumption gives us the private savings. So when you deduct taxes and consumption from the disposable income, we end up accumulating private savings. Y minus T minus C. Government saving, on the other hand, is the net tax revenue. Government saving is the saving of the government. But the only way for the government to save is to collect taxes. Government saving is the net tax revenue, right? Which we find according to the formula of T, meaning taxes, minus government purchases. So what we do is that we deduct the government expenditures from the taxes. Then we end up obtaining the net tax revenue. Okay, so taxation is very, very important to increase the government saving. But it's also important that the government should reduce its expenditures at the same time to maximize the amount of saving that it can make. Okay? As a whole, private and government saving add up to national saving. So national saving is found according to the formula of private saving, meaning SP, plus government saving. Here is the figure 13.2, which shows the US current account and net international investment position from 1976 to 2015. As you can see, the United States has a negative current account balance, and it also has a decreasing net foreign wealth. So when you see a negative trade balance, which is accompanied by decreasing net foreign wealth of the United States government, which also means that because America's net foreign wealth is decreasing, the United States had accumulated a substantial net foreign debt. Because of this decreasing net foreign wealth, we're also implying or concluding that our net foreign debt is also increasing. Current account deficits, starting in the early 1980s, reduced America's net foreign wealth. And by the early 21st century, the country had accumulated substantial net foreign debt. Thank you for listening to my lecture so far. In the next part of my lecture, I will talk about the balance of payment accounts of the United States. So far, we have talked about the national income accounting, which includes C plus I plus G plus the current account of the United States. In the next part of my lecture, I will talk about the balance of payments accounts. Thanks for listening to my lecture, and see you in part 2. Have a good day.